Intel Corporation just shocked Wall Street with its Q3 2025 earnings, showing the clearest signs yet that its massive turnaround might finally be taking hold. For years, Intel was the sleeping giant of the semiconductor world, too slow to innovate, losing share to AMD and Nvidia, and stumbling in manufacturing while TSMC took the technological lead. But now, the tide may be shifting. In its third quarter, Intel posted revenue of roughly $13.7 billion, up about 3% year over year. Net income came in around $4.1 billion, marking a strong return to profitability after uneven results throughout 2023 and 2024. Gross margin reached approximately 38%, showing meaningful improvement from the low 30s a year earlier. These numbers matter. They indicate that Intel's cost discipline and product mix are finally improving. The stock surged nearly 9% following the report, as investors digested the surprise rebound in profits and the improving outlook for its foundry and data center segments. After years of skepticism, the market is beginning to believe in Intel again. Not because it's dominating today, but because it's finally executing on a credible comeback strategy. CEO Lip-Bu Tan, who took over leadership earlier this year, is credited with driving sharper operational focus. Under his leadership, Intel has reduced overhead, cut non-essential programs, and realigned its resources toward the areas of highest growth: artificial intelligence, data centers, foundry manufacturing, and advanced process development. He's kept the long-term strategic goal that Pat Gelsinger started, transforming Intel into a true foundry powerhouse, but is executing with greater financial discipline. Let's break down what's driving the rebound. The Client Computing Group, Intel's traditional PC chip business, grew modestly thanks to strong demand for high-end CPUs like the Lunar Lake and Arrow Lake families. Average selling prices improved as consumer PC buyers shifted toward premium and AI-ready systems. The Data Center and AI Group also showed solid momentum, with enterprise and cloud providers refreshing infrastructure to handle new AI workloads. Perhaps most notably, Intel Foundry Services, the division once viewed as a money pit, posted over $1 billion in revenue for the second quarter in a row. It's still early, but this business is starting to gain real traction. External customers are signing up to manufacture on Intel's 2nm and upcoming 18 angstrom process nodes, which are now on track for 2026 deployment. These nodes could make Intel competitive with TSMC for the first time in nearly a decade. Another key reason for Intel's surge is renewed investor confidence. Major institutional players, including SoftBank Group and Nvidia Corporation, have recently invested in Intel's manufacturing ecosystem. The US government has also taken a roughly 10% equity stake through Strategic Chips Act funding, effectively betting on Intel as a cornerstone of America's semiconductor independence. These partnerships reduce financial risk, strengthen Intel's geopolitical position, and ensure long-term support for its foundry expansion in Ohio, Arizona, and Germany. However, Intel's challenges remain significant. Supply chain constraints are still restricting production of certain chips, particularly those built on Intel 7 and Intel 10 process technologies. Intel has warned that these issues may persist into 2026. The foundry business is not yet profitable, and management has acknowledged that achieving break-even will take several years. Investors must remember, this turnaround isn't a quick trade. It's a multi-year story requiring patience and trust in execution. Despite the short-term headwinds, the company's progress in AI and next-generation computing deserves attention. Intel's Gaudi 3 AI accelerator, released earlier this year, is being adopted by enterprises seeking affordable alternatives to Nvidia's H100 and H200 GPUs. The performance-to-cost ratio is attractive for smaller cloud and edge AI applications. Intel is also pushing its AI PC initiative aggressively. The new Lunar Lake chips integrate neural processing units capable of handling on-device generative AI, a major shift as companies like Microsoft and Adobe design software around local AI inference rather than cloud-only computing. This could ignite a new refresh cycle in laptops and desktops through 2026 and 2027. From a broader market perspective, Intel's comeback is unfolding at a pivotal time. The global semiconductor race is intensifying, driven by artificial intelligence, data sovereignty, and national security concerns. Governments in the United States and Europe are pouring billions into local chip manufacturing, and Intel stands to benefit as one of the few Western companies capable of advanced process production. If Intel successfully scales its foundry operations, it could capture not just commercial customers, but also critical government and defense contracts, revenue streams with high stability and long-term visibility. Technically, Intel's stock chart supports the bullish narrative. The shares recently broke above the $40 resistance level, forming a golden cross pattern as the 50-day moving average crossed above the 200-day line. Trading volume has increased steadily, confirming accumulation by institutions. Short-term and momentum indicators suggest continued upside toward the mid-40s range if upcoming quarters sustain growth. On valuation, Intel currently trades around 30 times forward earnings, below Nvidia and AMD, but above its historical average. That multiple reflects investor optimism about a successful turnaround rather than current profitability. The company also continues to pay a dividend yield of roughly 1.5%, appealing to long-term investors seeking both growth potential and income stability. Let's look closer at Intel's financial health. Free cash flow has turned positive again after several quarters of negative results due to massive capital expenditure. Intel expects to generate several $billion in free cash flow by the end of fiscal 2025, as margins expand and supply constraints ease. The balance sheet remains strong, with over $20 billion in liquidity and improving debt ratios thanks to strategic partnerships that offset heavy fab spending. Intel's future will hinge on its execution of 5 pillars: process technology leadership, foundry profitability, AI, and data center growth, cost control, and product innovation. If it hits milestones on its 18 angstrom node and secures recurring foundry clients, Intel could re-enter the conversation as a true competitor to TSMC and Samsung. Now, let's examine the competitive landscape. Nvidia dominates AI GPUs, but Intel has a different angle: CPU-AI integration. AMD continues to push its EPYC server chips and Ryzen processors, but Intel still owns substantial market share in enterprise computing. TSMC remains the foundry benchmark, yet geopolitical tension between China and Taiwan underscores the importance of Intel's Western-based capacity. This factor alone gives Intel a strategic premium. Governments and corporations alike want supply chain security, and Intel can provide it. Another overlooked catalyst is Intel's software ecosystem. The company is investing heavily in OneAPI and open-source AI frameworks that optimize performance across CPUs, GPUs, and AI accelerators. If Intel succeeds in creating a unified developer experience, it could lock in long-term customer loyalty similar to what Nvidia has achieved with CUDA. The macro environment also plays in Intel's favor. Global AI infrastructure spending is expected to exceed $300 billion annually by 2027. Even a small percentage of that market could significantly lift Intel's revenue base. As the world transitions from centralized AI cloud processing to distributed on-device computing, Intel's hybrid approach of AI PCs and data center integration positions it for sustained relevance. Still, risks remain. Execution missteps, manufacturing delays, or competitive pricing pressure could derail progress. Additionally, while government support reduces financial risk, it also adds political oversight that may slow decision-making. Investors should monitor capital discipline and ensure that Intel doesn't repeat its past mistakes of over-promising and under-delivering. To sum it all up, Intel's Q3 2025 report marks a clear inflection point. Revenue growth, profitability, external investment, and technological progress all signal a company regaining its footing. For years, Intel lagged behind, but it's now showing tangible signs of a comeback. This is no longer a story of survival, it's one of reinvention. Based on fundamentals, technical strength, and the macro environment favoring onshore semiconductor manufacturing, Intel appears to be a moderate buy for long-term investors. The upside lies in its Foundry expansion and AI integration, while downside protection comes from a diversified product portfolio and government backing. If you found this analysis helpful, make sure to like, subscribe, and hit the bell icon for more weekly deep dives on the world's most influential companies, reshaping technology and investing in 2025.